when investors recognize that, wait a minute, inflation is not going to be 2%, it's going to be more like 10% or whatever it is. And now you have to figure out, well, what is a gold and what is an ounce of gold worth today if inflation is going to compound at 10% instead of 2%? Well, what is it worth? $10,000, $15,000? I mean, I don't know. I haven't really done the numbers, but it's worth a lot more than what you think it's worth when you believe inflation is not a threat and is going to stay low. So at some point, just like when reality hit the subprime market and all of a sudden the bottom dropped out and there were no bids and it went to zero, when the market investors come to the same realization about inflation, then gold's going to soar. There'll be all bids, there'll be no offers. Nobody will want to sell gold at these prices, and the price will go up very quickly. How high, it's hard to say, but much higher than it is now. And the same thing is happening again today. I mean, the bubble that we have now is actually larger than the one that popped in 2007, 2008. But the same people who couldn't see that bubble don't see this one. And they're going to be just as blindsided by the events that are going to unfold. And, you know, these are not like black swans, right? These are ordinary white swans. It's just that, you know, people don't want to recognize the problems. And the people who didn't see the 2008 financial crisis coming, they didn't see it coming because they didn't understand the nature of the problem. They didn't understand how Fed policy had created the problem. And it's the same Fed policy that created the bubble in housing that has created the bubble we've got now. And everything the Federal Reserve did following the 2008 financial crisis to get us out of the crisis just laid the stage for the crisis that's coming, which is going to be much worse, because the mainstream Wall Street people still don't get that the Fed didn't solve a problem that the market caused. And also, in order to really bring down inflation, you need to see a contraction in credit, and we're not seeing that. We're seeing credit expanding. We have record high credit card debt and record low savings rates. So consumers have not altered their behavior as a result of the Fed rate hikes. They're not saving more and borrowing less. They're saving less and borrowing more. And they continue to spend everything they earn and then some. And that puts upward pressure on prices. And the U.S. government has not cut spending, which is what would be required to fight inflation. Spending is increasing, and so are the deficits necessary to finance it, which puts a lot of pressure on inflation upwards, because now the central banks ultimately will have to do a about face on QE and go back to quantitative easing in order to finance these deficits. Otherwise, long-term interest rates could explode higher if the government needs to finance the debt privately. And, you know, a lot of people don't realize how difficult it is, right, to get that inflation genie back in the bottle. You know, there's a reason for that expression, because people learned the hard way. You don't want to let that genie out of the bottle. You know, you go back to the 1970s when we had high inflation. Volcker came in 1980 and tried to, you know, put that genie back in the bottle. The Fed never achieved a 2% CPI until 1986. That was 6 years later, by the time the inflation got down to 2. And in 1986, you had a Fed funds rate hit a high, I think, of 16% in 1982. Well, we're not even at 5 yet. So if it took 16% back then to get the inflation rate down to 2, and it's not like it stayed at 2. The Fed got to a 2% inflation in 1986, and then it took 12 years to do it again. All the years between then were way above 2%. So now you have Powell saying, oh, we're going to get inflation back down to 2% and keep it there. Good luck. People have faith in the dollar. They trust the dollar. They believe in the dollar. They're going to be disappointed. That, you know, they're going to end up losing a lot of money. Look, just like we started talking about subprime mortgages. A lot of people bought into that nonsense. They own subprime mortgages. They believed the AAA ratings. They thought they were going to get their money back. Now, to me, it was obvious. I was talking about how these securities should have been rated F because they were going to fail. I mean, the dollar's lost about 99% of its value since then, measured in gold. Because back in 1913, a dollar, you only needed $20 to buy an ounce of gold. Right? So if you had $20, you had an ounce of gold. Now you need over $1,800 to buy that same ounce of gold. So that's a huge decline in the purchasing power of the dollar. over that 100-year time period. But in contrast, if you go back to the 100 years, right, before the Federal Reserve, the dollar didn't lose any of its value. I mean, it was $20. $20 bought you an ounce of gold in 1813, and it bought you an ounce of gold in 1913. And in fact, if you look at the consumer price index during those 100 years, it actually went down. So you could buy more with your dollar. Now, try to compare prices today to what prices were in 1913. I mean, stuff that cost a penny back then is, probably a couple of bucks, right? And something that cost 10 cents is, 20 bucks, or do the math. But prices have just skyrocketed over this 100 years. But 100 years of sound money, prices went down. The dollar maintained its value when the government couldn't create it out of thin air. Well, it should be a lot higher, but it's not. It will be. The reason that gold prices are still as low as they are is because I don't think investors understand the situation, just like they didn't understand the situation in the mortgage market. When I was shorting these subprime mortgages, initially when we first shorted them, they were trading at about 104, 105. They were trading at a premium to what their par was. Now, they ultimately went to zero. They were worthless. But for a period of time, people were willing to pay a premium to buy basically a worthless security. Why? Well, because they didn't know it was worthless. They expected the mortgages to be repaid. Why? Well, because they thought that real estate prices could never go down and that they couldn't lose money. Look, I think there's a lot of support around 1,800, so I really wouldn't look for prices to move much lower than that. If they move lower, there is some resistance, probably 1,900, 2,000 up towards the highs, below 2,100. But once we really get above 2,100, there is no resistance, right? We're at all-time record highs, and I think, you've got clear sailing. Again, it's a question of when is the narrative going to change? Now, I am in the pivot camp. I firmly believe that when push comes to shove, the Fed will pivot, meaning that when the fight against inflation does enough collateral damage to not just the markets, but really the financial system and the economy, when you start to see potential bankruptcies or defaults, when you start to see the beginnings of, or maybe even a financial crisis. Because remember, the financial crisis of '08 was a result of higher interest rates. That's what pricked the bubble. And the problem was a lot of debt was taken out that couldn't be repaid at higher rates, right? So the same thing is happening now. It's just not concentrated in subprime mortgages. It's just more broad. There's a lot more debt that is non-payable. But the banks that were too big to fail in 2008 are even bigger now. And I think they're even more exposed. And they could still fail, except that these banks failing now would have much greater adverse consequences than what the consequences would have been had we let them fail, in 2008, 2009, whatever that would have been. And so when we get to a breaking point where the Fed has to make a decision between, do I keep fighting inflation because it's still above 2%, or do we try to stimulate the economy because it's imploding? Do I have to bail out these banks? Do we have to bail out hedge funds, or the U.S. government? What if the U.S. government is at a point where it can't make its Social Security payments? It can't pay interest on the debt. It needs the Fed's help. Is the Fed going to provide the help, or is the Fed going to tell the government, sorry, we can't help you. Inflation is still 5%. We have to keep on doing quantitative tightening. We can't buy any of the bonds. You just got to default, right? You got to tell the people on Social Security they can't get their money. So I don't think the Fed is going to do that. So the question is when. I think what the markets are finding out is that the pivot is not going to happen as soon as they thought, right? Because the inflation numbers are surprising everybody by how strong they are. Now, it doesn't surprise me because I've been saying the whole time, inflation is not going down. The Fed is not going to cut rates because it wins the battle against inflation. It's going to cut rates despite losing. It's going to surrender because it's going to find another battle that it thinks it's more important to fight. Economy starts to collapse, we have a deep recession, rising unemployment, we have a financial crisis, and the Fed reaches for the only tool that it has, the only tool that it's ever had, which is to create inflation, to try to inflate our way out of the crisis. How is that going to work when they're doing that at a time when inflation is already high, right? See, when they used that so-called tool after the financial crisis, and they kept using it up until 2021, it was because the official inflation rate was still below 2%, and they could say, oh, we need more inflation so we can have this inflationary policy without any adverse consequences. In fact, it's a twofer because we actually need more inflation. Our goal is 2%, and we've only got 1.5%. So, we actually need a little bit more inflation. So they were able to make up that BS. But, now that inflation is 8% or whatever, they can't say we need more inflation. And so if they decide to deliberately create inflation because there's another problem they're trying to solve, they're going to make the inflation problem much worse. That's where you get the potential hyperinflation, where you completely destroy the value of the dollar, which means you've destroyed the value of U.S. Treasuries and all obligations of the U.S. government to pay dollars.